Thank you for joining us. I'm Gord Long. It is my pleasure to have back with me this morning Charles Hugh Smith, well-known and prolific writer on the web, who is the publisher of the website of2minds.com. Good morning, Charles.
Good morning, Gordon. Always my pleasure to be on the program.
You're coming to us from Hawaii again. Does that mean you're going to come back to California for the winter?
For the holidays.
Well, Charles, I want to continue from our discussion we've been having over the last, few months now, which we titled The Results of Financialization. And this will be part 3. For those that haven't been following this series, in part 1, we discussed the current debt for equity swap underway, as well as the ramifications of zombie corporations, both a direct result of the financialization of the economy, which we've been witnessing basically over the last 20 to 30 years. In part 3, we discussed whether we should expect the equity markets to possibly be nationalized during the next crisis, and what we meant by the new form of nationalization. In this session, we hope to discuss more of what the future holds. And because what we've had is obviously a massive expansion based on credit and leverage, to the point that we've outlined in other shows the amount of over leverage that we currently have in the economy, and therefore what would be the potential impact of all of that if we had inflation. And to do that, we thought we would springboard from a remarkable recent report from the Bank of International Settlement that we'll get into. I have here the agenda. We both thought we would be useful for that discussions. But before we begin, any comments, Charles?
Well, Gordon, I would say that this topic is quite profound and fairly complex. But I think it's the core dynamic going forward in the next 10 to 20 years. And so it's really worth trying to understand this, what we're calling the big reversal, from deflation to inflation, and from declining interest rates to rising interest rates.
And I'm sure a lot of our listeners are going to disagree with us on this because it is rather controversial and it is so major a change. But I think if you study it and really go through the points, there's a very high likelihood this will happen. I would even use the word strong likelihood. In the first 2 videos that we did on this, Charles, I took the lead. But in this one, you're going to do so. And I thought we could begin with the 10 points, which put some further real-world flesh from your writings on the academic thinking behind the Bank of International Settlements report. Before we do that, Charles, I just thought for those listeners not familiar with the report itself, it basically, in summary form, just outlines that savings and investment will fall in the future years. That is no surprise to anyone. But what they really argue is that, in fact, savings will fall faster than investment, fundamentally because of entitlements. That is, in the United States, we call it Medicare and Social Security, but in all the advanced economies, there's some form of that, entitlements, and that is not investment. That is consumption, and it subtracts from savings. And so, therefore, when savings are falling at a faster rate, though they're both rising in actual fact, than investment, then real interest rates will rise, inflation and wage growth will pick up, and inequality will fall, which is exactly the reversal of what we've been experiencing for the last 20 years or 30 years. But what makes this Bank of International Settlement report so interesting, not only is the conclusion, is they actually, for the very first time I saw it, Charles, is they looked at things on a global basis. They looked at labor on a global basis. They looked at demographics, and as opposed to individual countries in the past that have always looked at in that context. And therefore, they're key determinants of the importance of China, the social safety net in advanced economies, and the global approach to demographic really brought out their conclusions, which is what's missing in a lot of the reports. Comments on anything I might have missed there in kind of recapping that report, Charles?
No, Gordon, I think you did a great job to mention the economic dynamics of savings and investment. And I think what I would start with to build on that would be what this report is so powerful and why it's so powerful is that it's talking about demographics, which are already dialed in. In other words, we're not going to change the size of our workforce next year by creating more debt and leverage, or dropping helicopter money. In other words, demographics are not controlled by the central banks. These are generational dynamics which are already built in. And so we had a vast expansion of the global workforce, which was partly driven by globalization, right? The access to the Chinese labor market and the Indian labor market and so on. But it was also demographic, that there was the generations that were entering the workforce were extremely large. Now, what the BIS report is saying is the number of people who will be leaving the labor force in retirement, not just in the U.S. and Europe and Japan, but also in China, is vast. And so it's going to overwhelm. It's going to shift the demographic balance from there being more and more young people entering the workforce. Now that's reversing to there's going to be more and more people leaving the workforce. And the fundamental dynamic is there's been an oversupply of labor globally, which is why wages have been stagnant for decades, right? Because once we're now competing with every other worker in the entire world economy, right? Well, that's going to switch around, and now we're going to have labor shortages. And even with automation destroying jobs and replacing human labor, there will still be this whole trend is reversing. There's going to be fewer workers and more retirees, which is going to put even more pressure on the entitlements that you mentioned. And so these are big changes that are going to take a generation to play out.
I think, Charles, you're right on. And I think everybody, well, those that follow it, certainly in the developed world, really understand the magnitude of the baby boomer snake, body going through the snake, and now it's falling off. But I think everybody also forgets that the post-World War, World War II economies that suffer, or that saw the baby boomer impact over the last 50 years, forget that in other areas that were not involved in the war, such as China, they went to other policies such as one child, and as opposed to multiple children, and laws to have it. So they, in fact, have a reverse bubble in a absolute dramatic shortage of labor coming into the market that they've experienced. So it's a compounding problem, which is exactly your point. A dramatic shortage of labor at the same time, which is trying to support a dramatically larger increase of those in the out years. And the basic problem with that is how do they support the whole social safety net that's built out right around the world, especially in developed economies. There's no doubt that social safety net will be restricted. There will be, I'm sure we're going to see reductions. We're going to see qualifications for means testing, if you would, etc. But that means, that does not mean for one moment it's going away. And as I said earlier, we got to remember that's consumption. That isn't savings, and that's a huge burden to pick up. And so the only way you're going to pick that up is that suddenly, with investment, where's the money going to come from? And that means that money is going to be more expensive. And when money's more expensive, it's called inflation, at least on interest rates, element that goes into that.
Right, exactly. And so just to kind of refresh the listeners' recall, back in the good old days of the 60s, there was 8 to 10 full-time workers for every retiree, right? Then it slipped to 5 workers for 1 retiree. Well, right now, in the United States, it's 1 to 1. There's approximately 110 million full-time jobs, and there's 110 or 20 million people drawing Social Security and Medicare and other social benefits. And so you can't do that. The demographics doesn't work. And so what Gordon and I are discussing is the governments will have no choice but to borrow immense sums to try to fill this gap between the stagnant tax revenues, because the workforce is stagnant, and the fast rising cost of entitlements. And I want to describe another dynamic here is, with globalization and the neoliberal sort of form of capitalism that we've characterized in many ways, state cartel capitalism or crony capitalism. You can look at our archives for our programs on that topic. The bottom line is it's been very deflationary because you've had these huge investments in low-cost markets like China that have produced a tremendous amount of commoditized goods, which have reduced the prices of goods globally. And it's also reduced the value of labor, hence the stagnant wages we've been talking about in the developed world. Well, so what do the central banks in the developed world do to increase growth when wages are stagnant? You can't borrow more money if your wages are flat or declining. So they've lowered interest rates and boosted liquidity, increased the financialization, trying to fill the gap that used to be filled by higher wages. They're trying to build demand by lowering the cost of borrowing money. Well, that sounded good in theory, but what we've seen in the last decade is all that speculative leverage ends up going into asset bubbles. It doesn't go into building new factories or starting new companies. In fact, the growth of new companies has fallen into negative territory. I mean, small businesses in decline as are startups. So now we have these asset bubbles that have further enriched the wealthy. In other words, approximately 75% of all the assets are owned by the top 10% of the households. And so that's creating the social disorder or social discord that we've discussed in previous programs. And so that dynamic has kind of run out of steam. In other words, you can fill the difference between, stagnant wages and trying to boost higher consumption by increasing debt for a while. But then you have the problem of servicing that debt. And that's where we are now, is that the cost of servicing the debt is low currently because interest rates are low. But should interest rates have to go higher, then the system is under tremendous pressure.
The cost of servicing the debt, and let's say it's approximately $230 trillion in the world, the cost and the fig, if you would, on that interest is now consuming all of the wealth that's now being created on a $73 trillion economy. And I've done a number of analyses that show that shortfall. And that shortfall, by the way, is made up currently by the central banks printing approximately just north of $200 billion a month. Now, based on currently the optimistic forecasts that, in fact, the economy is starting to grow. I disagree with that based on global trade, but based on that, the central banks feel that they can now start to normalize balance sheets in the case of the Fed, begin taper program, though they don't call it that, but that's what it is in the ECB, and start to somewhat reduce the rate of increasing reflation in areas such as China, but it's just the debt burden is so high, and if interest rates go up, Charles, as you're suggesting, the problem right now is the collateral has been pledged to build up this highly leveraged economy will absolutely critically implode. Obviously, the central banks are not going to allow that to happen, are going to do everything possible, and are currently, even as we talk. And what that means is that they will be forced into all sorts of techniques that we've referred to as helicopter money, guarantees, etc., on an ongoing basis, buying the equity markets. They will have to and must maintain keeping these asset values relatively higher. What that means is the cost of money, based on what we were just talking about earlier, will go up. The real rate of interest rates will start to rise. That is a dramatic reversal from what we've experienced since 1980 and the fallout that comes from that.
Right, exactly, Gordon. And we have discussed in previous programs that the economy and bond yields and stock markets, every market, even one as manipulated as the ones we have, follows a cyclical pattern. And the bond market, in terms of yields and interest rates, is a very long cycle. typically 25 or 35 years. And here we are basically pushing 35 years. This is a very long in tooth cycle of interest rates declining. And what we're talking about and trying to tie together is the demographic pressure on consumption as retirees exit the workforce. Then they spend less money. They start depleting their savings. They start selling their stocks and bonds to fund their life. And so we're seeing these huge reversals. Instead of having savings expand along with the workforce and higher wages, we're seeing wages stagnate, people leaving the workforce and needing to sell. And so where's the investment going to come from? And what we see in Japan is they have the demographic problem. They're a few years ahead of the rest of the world in a vastly expanding population of retirees. So as we've discussed, what the government's done is it's simply replaced private demand for investments such as bonds with central bank buying. In other words, they're the ones who are owning the markets, which is what we were saying is the new form of nationalization. But this doesn't really solve any of the problems, and that's really what we're talking about. It doesn't change the demographics. It doesn't expand the private sector's savings. It doesn't make wages go higher. And so it's just a stopgap measure. But eventually, stopgap measures run out of room.
And every time we've found that happens, and we did a show here a while ago, Charles, we saw that the government came in, and I talked about the government here, not just the central bank, came in and changed the rules. They changed the rules in the financial markets, whether it was mark-to-market, whether it was Sarbanes-Oxley. There was a whole series that we outlined that have been changed every time we had some kind of financial crisis. So you can expect that. And so no way are we talking about in this reversal a massive crisis. That's not it. What we'll have is ongoing scares that will prompt and justify these kinds of actions as we migrate into different types of programs where we talked about conservatorships, guarantees, etc., to keep the system somewhat liquid. And by that I mean liquid afloat, because we've talked about that we have a $400 trillion pension obligation on a global basis right now. And that's all based on their investments in securities. So that's got to be maintained. And again, we go right back to where's that investment capital going to come from? Well, it'll come. We will create it. But it's going to be funded by it'll come from the government printing money, handing it directly, not even through the banking system, through helicopter money, through other techniques. But it'll make right now savers are getting killed. In the future years, if they can get to that point, those who've saved and have money will actually be much better off. Right now, they're being seriously penalized with programs that we refer to as financial repression or the macroprudential policy that supports that. Charles, what should investors do?
Well, it's an interesting question, Gordon, and I want to introduce one more. There's two conundrums here that we're going to discuss. One is taxation and the cost of the pension obligations that you just mentioned, is that as we're seeing in high tax states such as Illinois and California, the local government agencies are having to raise taxes or slash government services in order to meet these pension obligations. And this dynamic has just barely started. But the problem is if you raise taxes, you're taking money away from households that can no longer be spent on consumption to keep the economy afloat. And so if you raise taxes high enough, you get a recession. And so, and which then reduces your tax income even more. So then that creates a very perverse cycle in which, to compensate for the declining taxes due to a recession, you raise taxes even more, which deepens the recession, and so on. So there's no way out of that conundrum. You can't solve that. You can't say we're going to fund the pension obligations by raising taxes, because wages are stagnant. That is impossible. You can't fund those by just raising taxes as you could back when there was 8 workers for every retiree. And when there's 1 worker for every retiree, no way. You can't do it by raising taxes. And then we look at as you say, by expanding the money supply essentially and dumping trillions of dollars in guarantees and helicopter money, that's going to create inflation that cannot be denied. Right now, we know there's high inflation in healthcare, in higher education, in national defense spending. All these things are the results of cartels raising prices but not providing any more goods and services, right? And so that's the definition of real-world inflation, is when there's more money chasing the same pool of goods and services, you're going to get inflation. And we see like 6 to 10% inflation annually in healthcare and higher education. But we're going to start seeing that everywhere. And once that's undeniable, that the government can't claim that inflation's only 1% when it's really running at 5 or 7%, then who's going to want to buy a bond at 7 when inflation's clicking along at 7%, buying a bond that pays 1/10 of 1%? I mean, you're losing 6.9% every year. And so there's going to be even with the government trying to intervene and buying huge chunks of the market, you're still going to see a pressure on higher yields, because they're not going to be able to engage any private sector money if you're basically asking people to lose 7% of their money every year.
And we talk about the rates going up, it's going to be the real rate that will go up also, not just the nominal rate, but the real rate. And remember, as Charles was just saying, with inflation going up, that's making it really hard for the real rate to grow. But that's what they're going to have to balance. Charles, just before we started recording here, I was listening to all the government, the Congress, U.S. Congress, announcing the tax bill, or at least the outline for the new tax plan. And every person that went to the podium to sell the tax plan that was coming, tax reductions, what was remarkable to me is they all talked about the tremendous burden on the consumer in America who is tapped out, the middle class who has no money, example after example of people living from paycheck to paycheck, and the only solution was a massive tax reduction for the middle class and for actually right across the board, for in some degree everybody. At least that's the stated objective here of this new tax plan. But it was an acknowledgement right up front, though they never used the word inflation, that the burden and that wages are not growing, wages are stagnant and have been for so long that people can't survive. And therefore the governments began to, they're arguing they're forced to bring in a tax plan to do that and to stimulate the economy. What was left out was, can they in fact balance a budget? And the answer is quite equivocally not a hope that that'll be the case, which means more borrowing, which is more pressure from capital that's got to be found to finance this, and which compounds the problem. So they're caught. And the positive on this, Charles, for investors is when they're put in a trap like this by their own doing, since we came off sound money years ago, and the fact that we're consuming more than we produce, which has led to these kinds of problems, and having kicked the can down the road, you can see what they're going to be forced to do. Therefore, your ability to invest becomes much clearer. You're not taking as much risk. And the key then is to figure out a roadmap that will support that.
Right, and I just want to wrap up the slide here on interest rate conundrum. So what we're talking about is the central banks are trapped, because if they keep interest rates near zero, they're simply funding speculative leverage that goes into asset bubbles, which are already at extreme valuations, and then they're going to try to push those higher. Well, if they do, they're increasing systemic fragility, and they're also creating more social unrest, because we're living in the new Gilded Age where the super rich get richer every day that the central banks keep interest rates at zero and flood the system with liquidity. It's only making the rich richer. It's not helping the middle class and the working class, as you described. So that's a dead end. They can't just keep thinking they're going to save the system by pushing asset bubbles ever higher. That's going to run into social unrest, which is going to take that dynamic down. That's what history shows us. Or if they let yields rise, then this existing massive overhang of debt, which is what the BIS called it, is unaffordable. It's going to suck up all the income of the entire nation just to service the existing debt. So they really are trapped. And so I think one of the key points I would say in terms of what investors should do is don't get tied into some long-term yield. You have to have an asset that you can raise the price on. In other words, to compensate for rising inflation. So if you buy a 30-year treasury that pays, some, 1 or 2%, well, you're at high risk of losing money as interest rates go up, right? Whereas if you own an asset that you can raise the price to at least go along with inflation, then at least you can protect your capital.
Well, you need to be, and we've talked about this all going back 2.5 years now, Charles, that you have to be moving towards investing in unencumbered income generating, discounted free cash flow kinds of enterprises and or assets. And trying to find those. It isn't just hard assets. The problem with hard assets is it's an appreciation game, or really it's a devaluation game, and it's an insurance policy. But to grow and become wealthy, you have to be creating income. So you need to find things that will really, as you say, generate income in a slow growth, recessionary, or even worse kind of environment. To be stable. Those will be the new investments that will be going forward. I'm not even going forward. They're right now. Everybody that I talk to, that's all 2 years ago, all they were looking for hard assets. Now they're looking for real income, and they're usually local, Charles. They're not necessarily global. There's small businesses that generate really good cash flow, and trying to find positions in there or ways of getting into it. But jumping back to your comment, if I could, Charles, on equality and inequality, the Bank of International Settlements, IMF, OECD, World Economic Forum have all been absolutely hard, and they're the guidance that the central banks really listen to, along with their own internals. And they're all talking about the level of inequality that the current programs have generated, and that in fact it's going to, as you say, lead to social discord of significant proportion, and that has to be end run. Now, what we've had in the last 20 years is we've grown tremendously inequality within countries. The United States is just a typical one of that, the haves and the have-nots. But what we did is, on a global basis, we reduced inequalities, because a lot of the countries that were behind it's a closer balance. That's the good news. In the future, going forward, the inequality within the countries will become less than we've had before. That's a good news. That's a positive going forward. If they take the lead. From what these agencies or groups are saying, like the IMF, but I think it's more that they'll be forced into it. My only hesitation is that there's so much fragility in an over-leveraged economy that things can crash and they can lose control very, very quickly. It's going to be a very, very difficult thing to do. Any closing comments you'd like to make, or further comments, Charles?
Well, Gordon, I think your last statement had a very profound point, which is they're going to lose control, and that means that what's scarce is going forward, and therefore is most valuable, is control over your own assets. If you own shares in some multinational, or you've got all your money in a 401k that the government can expropriate, you're not really in control of your assets. And so when you talk about local assets and small business assets, these are the kinds of things that you and I are saying you should look at, because if you control the asset, then that's like half the game. That's what the super wealthy always seek, is control of the assets, not just ownership.
When we have a crisis, or when there's a crisis, in almost wherever you go through in the country, you'll find that the governments or the central bank seize control of the pensions. And people who are going to be dependent on those public pensions or private pensions. And what they do is it's because they're going to protect you. They're in trouble. You need to be protected, but they need the capital in those pensions shore up the economy. So they have control of it. You'll get money, but you won't get what you expect, but maybe you'll be just happy to get something in it. But those who have, and I'm not suggesting being out of the pensions, but those who have control of their assets, and those assets are in products that we've been talking about, that is income, real products, secure, can face downturns, you'll have more control, and that control is everything to support your point, Charles.
Absolutely, and so I hope we've explained the tremendous I don't know how to say it, the predictability of these large forces of demographics and shifts in debt and in investment and savings, that it's going to really, it's really pushing the central banks and central government authorities into blind canyons. There's no escape. They can't just print their way out of it, and they can't even expropriate or tax their way out of it. And so there's going to be fundamental systemic changes in the next 10 to 15 years.
I encourage all our listeners to actually read the Bank of International Settlements report. There's so much that needs to be considered in whether this discussion we're talking about real-world observations that we see every day. It's not too academic, but there's some great charts in it, some great arguments, and it's really worth a quick scan if you want to take this further, which will support what we've been saying here today. Charles, always a pleasure. We have to wrap, and we'll be back next month with another thought-provoking discussion.
Yes, I look forward to it. Thank you so much, Gordon.
Talk to you then. Bye.